Friday, and thank you so much for joining us today for our webinar on how to beat the S&P 500 with less risk. The webinar has begun. Please note the risk disclaimers herein as a part of the presentation. Brought to you in combination by Annuity FYI, America's leading independent resource for fixed and variable annuities, and Tom Hamlin, CEO of Somerset Securities and Somerset Wealth Strategies. My name is Valentina Garfinkel, and I'm going to be your host for today's webinar. Our goal is to respect your time and to keep this around 30 minutes with an additional 15 minutes for Q&A. So if you have any questions, please feel free to put them in the chat below. In addition, we will be recording this webinar so that we can place it on YouTube and other social channels so you can watch it twice or share it with others as well. And for those of you who are unfamiliar with Tom, Tom Hamlin is a financial professional and annuity expert for 33 years, and he is considered to be one of America's top annuity experts and producers, helping his clients invest over $1 billion of premium in fixed and variable annuities over that period. With that being said, Tom always takes the time to point out that this wouldn't have been possible without his amazing team. So without further ado, here's Tom.
Thank you, Val. Good morning, everyone, and happy Friday. Thank you for joining us here. It's morning out here in the West, and it's noontime shortly after our in the East. So thank you for being here with us today. Yes, today's topic is how to beat the S&P 500 with less risk. We're going to go into three plans. One of the plans is not going to outperform the S&P 500 by design, but it has zero risk and zero fees. Another one is going to outperform the S&P 500 on the upside and the downside. And the third one is going to equal the S&P 500 on the upside, but on the downside, I have a special treat for you there. So, and I think that everybody will be somewhat in awe of it. So what is up on the screen now here? We've got investors are currently facing, stock markets are at record highs. This just happened yesterday again. Bonds have been hit hard due to rising rates. The shortest end of the yield curve is up over 5,500% from 2021, where the 1-month Treasury hit 0% 10 times in 2021. So if it was at 1 basis point and it was at 550 yesterday. That's a 5,500% spike in interest rates because, in my personal opinion, the Fed waited too long to hike interest rates. They were practicing in the woods and they turned their back on a controlled blaze and it got out of control. Now they're waiting, in my opinion, too long to ease those interest rates. But in spite of that, and in expectation of lowering them starting to ease, the Fed, we are seeing a booming market, and it's just really hard to figure out the market. Most advisors fail to outperform the S&P 500. Most hedge fund managers who have been killed in recent years, not outperforming at all. ETFs, mutual funds, most of them don't outperform the S&P 500 or the NASDAQ QQQ for that matter. And we're going to talk about that. So, you know, in other words, why would you pay money to an investment professional just to underperform the markets? It seems nonsensical. So we're going to go into that. We expect that inflation is going, although it's been persistent, we expect that it's going to be easing. We're actually anticipating deflation in the next 2 or 3 years, because this inflation that we have right now is manufactured inflation brought on by the Fed, throwing plus or minus $10 trillion on the friends and family bonfire at the beach, as I say. But that's going to burn off. And then we're going to have to look at just, you know, how productive we are as an economy in order to provide, you know, in order to, you know, dictate pricing. And I think, and a lot of other people think that it's going to be actually not just being disinflation, which is decreasing inflation, but de-inflation, which is negative inflation. The real estate market is actually in very bad shape. The rates are adjusting on the commercial side in 2024, 2025. People, commercial real estate groups coming out of 5 and 10 year loans, and they're having to renew instead of at 2 to 4%. You're talking anywhere from probably 7.5 to 10% or more. So we're going to have to watch that closely. A lot of smart people believe there may be as much as $1 trillion in defaults in 2024 and 2025 in the commercial real estate space. So, you know, anybody who would like to contact me on these matters, we can discuss all of that and how it fits into your portfolio. Near term, we've got uncertainty with the markets. And we certainly hope that inflation will start to ease. In terms of, I saw COVID there, markets doubled since COVID started. Val, can you go to the next one, please? So the potential solution: participate in the markets for upside potential and mitigate downside risk with registered index linked annuities. These are variable annuities. They're sold by prospectus. They offer some downside protection, limited protection of 10 to 20% typically, sometimes up to 40%. And then we're going to share with you an FIA, fixed index annuity, that does not have a prospectus. It has no fees and it has no market risk and very low credit risk. The products are the Athene Amplify. Longtime clients of mine, many of you own this product. I own several of these contracts. It's an incredible contract. And the same goes for the Equitable. That the Athene is the one that will outperform the S&P 500 on the upside, and it will outperform it on the downside. The question is just how much of the downside will it cover if we have a really bad market? That's where the Equitable comes in. It's going to equal the S&P 500 on the way up. On the way down, I'll share with you more about the protection on that one in a moment. And the Pacific Index Foundation 10 product is an outstanding product that has no prospectus, no market risk, no fees, and market goes down 25%, you're going to lose nothing. your 100,000 or whatever you put in will still be at 100,000, and it does require 100,000 to receive the top tier performance participation that I'm going to be discussing in a moment here. Go ahead, Val, to the next slide, please. Annuity sales are up. And this is the 2022-2023 slide. We showed you the previous year, you'd see that they were up as well. Why are people investing in annuities as opposed to doing more with money managers? You know, you've seen the commercials, Ken Fisher, I hate annuities, and so should you. I'd sooner die and go to hell than sell anyone I know an annuity. Well, he's wrong. And great marketer, but he's wrong. He lost 47% in 2008. The S&P was only down 37%. And this is what I'm talking about. Professional managers severely underperforming the market not just on the downside, but also on the upside. And that's why people are moving into annuities. And so go ahead to the next slide. Thanks. This is what we're going to talk about here. This is the Athene. So, Val, can I share my screen? Okay, let's see. Hopefully, let's see. I want to go to no. Let's see here. Go to. Let me go there. Okay, perfect. Here we go. So for anyone who contacts us and requests information, we will provide you with a plethora of information. This is their public site. You can type in Athene Amplify rates, and this will come up. You have a no-fee version. A lot of you own the original Athene Amplify. It just was called Athene Amplify. Now it's on the 2.0 version. I imagine at some point there'll be a 3.0. The 2.0 NF means no fee. You can buy it with or without a fee. We'll share this link with you, or you can just go to Athene Amplify rates. You'll see Registered Index Linked Annuities on the internet. And you click on it. If you see a guy with the surfboard off of San Clemente or San Onofre, you'll know you're at the right spot. You scroll down. Actually, I'm on that page, so I'll just scroll up. Here you go. And then you can come down here. I've never watched these videos, but I'm sure they're excellent. So if you go in here, this is where you want to be, this calculator. Just want to share a few things with you. This is what we talk about when we say outperforming the S&P 500. I hear all different kinds of stories about, you know, percentages. 79% of professional managers, ETF managers, mutual fund managers, hedge fund managers, financial advisors fail to outperform the S&P 500. I've heard numbers as high as 98.7. I can tell you that one thing I was taught many years ago, if you don't like the results, just change the dates. The dates can make liars out of all of us. So I just know it's very, very hard to outperform the S&P 500. And that's why John Bogle, the father of the S&P 500 index as it being made available to investors, he left State Street Mutual Funds back in the early 70s. And then he founded Vanguard, which was structured as a nonprofit because he believed so strongly that passive investing outperforms active management. And I'm not saying that one's better than the other. I'm saying that it's good to have a yin yang and diversify, because if two strategies or two people always agree in business, one of them is not necessary. So that's a healthy way to invest. I've selected the S&P 500. As you can see, there's other options in here. NASDAQ, Russell, so on, so forth. I selected 10% downside protection because this is the strategy that will outperform the S&P 500. A 6-year rate guarantee. They cannot change the rates on you. So that's wonderful. We're worried about, oh, you know, trust me, you know, this is going to renew at this rate. Well, here it's contractually guaranteed. So I hit calculate. So what are we looking at? 100,000 in the S&P. And you can see here, cap rate is 136%. S&P goes up from, you put in 100, S&P goes up 100%. You're at 230, you're at 200. Here you're at 236 minus a 0.95% strategy fee. Because in order to get that extra 36%, it costs something. So it's like going to the gas station. The 87 octane costs less than 93 octane. You're paying more for better fuel. And if you're going to be in a race, it's worth, you know, paying the extra amount. As I say, there's no such thing as cheap quality. And this is living proof of that. S&P was up 78%, 78.4 over the last 6 years, last fully completed year, 12/31 of 2017 through 12/31 of 2023. And as you can see, this Amplify was up 106. When you back out the fees, then you were at 195,000. You had a 95% gain. You just beat the S&P 500 that the vast majority of professional managers fail to outperform. And you did it right here, okay, with this product on a guaranteed basis. Now, let's look at the worst. Well, the worst period going back to 1980 and looking at the first 6 years in this case, and then that's 1 6-year period. Drop the first day of 1980, add the first day of 1986. That's 2 6-year periods. Do that through the end of, let's just say it was the end of the year. It's about 14,000 of those. The worst was minus 10.4, okay? In this contract, before the fee, you would have been at minus 0.4, but after the 95 basis point fee, you would have been at minus 6. You still beat the S&P 500 by 4%, 400 basis points, net. And so you beat it on the upside, you beat it on the downside. And there's a no fee version of this. We're not going to have time to go into that right now. I'd love to share, we'd love to share this link with you, as well as many others, to help not just sell you an annuity, educate you on all of this, because there's a spot for this in your portfolio. So let's see if we can get back to, you know what, Val, I'm just going to do it from here.
Okay.
We were here.
Yep.
Okay.
Hit
So,
slide.
all right. I'm going to go ahead and go on to the equitable. And, you know, any and all questions that anybody has, we're here to answer them. This is another incredible product. As you can see, there's more than one product. This is a site that you can go to. You don't have to log in. It says sign in. I'm clearly not signed in. Here it is. All of this great information. We're going to talk about that for a moment here. So here, I'm clicking on this. And it's downloading, boom. So if you go to the site, you click on this, this product's a little different. The Amplify didn't get into the fact that it's a 6-year commitment. It's a 6-year surrender period. You have access to 10% of your money every year, but it's not 100% liquid. This one is 100% liquid. They also have a product. This one has a 1.25% fee. The one with the 6-year surrender period has slightly lower participation rates, but it has no fee. So market goes, you know, well, I don't want to spoil the fun here. I'm going to go to, this is a 5-year guarantee. Now imagine this, I'll make it bigger. Okay. See this dual direction segment here? You have a 10, a 15, or a 20. What does that mean? Let's just focus on the S&P, which is our focus today. If the S&P 500, and these price daily, by the way, the Amplify prices daily, this one prices daily. You don't have to wait 6 years to see how well you're going to do, like with a fixed indexed annuity that has a 2 or 3 year index in it. It prices daily. You can get in, you can get out. And you can go back in the first and third Thursdays on this product. You can buy back in after you locked in gains and went out. Amplify is the 8th and the 22nd. But imagine that the market is up 300% over the next 5 years. I don't know if it's ever done that, but there's a cap on this of 400%. We'd love to have that problem. 400 divided by 5, that's 80% simple interest a year. Feels like about low 30s to me on a compounded return. I don't think it's ever done that 5 years in a row. If it did, it was probably once. But here's the exciting part. So you receive all of the upside of the S&P 500. There are no dividends on this, but the S&P 500 dividends are extremely low right now. You know, there used to be stats that said if it drops below 3%, you know, Katie bar the door, head for cover. Well, it's at 1.31 last time I looked, and it's been that way for many years for a number of reasons, not just because the market is high. If the market is down 20%, well, you make 20%. If the S&P 500 was down 20% over the next 5 years, you make 20%. If the S&P 500 was down 10% over the next 5 years, you make 10%. If you had $1 million in the market and the market went down 15%, you'd have 850. If you have this contract and the market goes down 15%, you have 1,150,000. But if the market is up 200%, your millions, 3 million here, as well as the S&P 500. You gave up the 1.31% in dividends, an amazing product. Here's another one briefly here, segment options. You have, look at this, invest in the NASDAQ or the S&P or the Russell or the EFA. Market is up 1% over 5 years. Market is up 0.1% over 5 years. You get the coupon. You make the 50, the 54, the 63.5, and or the 55. And you can buy a contract and you could be split up into 20 of these different things if you wanted to. It's really incredible. I wouldn't take the standard because you have a 500% cap. It's not going to go up 500%. You have 20% downside. If the market's down 20, you break even. Over here, market's down 20 or less, you actually make the coup. You make 20. If the market, by the way, is down 22, you lost 2, but you didn't lose 22. Pretty amazing. So that's the Equitable. And anybody who would like this deck, because as you can clearly see, we're following it, but well, I'm following it, but I'm not following it. Fixed indexed annuity, Pacific Life Index Foundation. Everybody knows their whale commercials. If you don't know the whale commercials, you're not watching TV or you're fast forwarding through all of them. So what is incredible about this product? It's a fixed indexed annuity. It's a guaranteed return annuity. Purchase this product, put $100,000 in it. If the market is down, let's go to here and let's see if I can, here, let's switch to slideshow. Boom. It's a little fuzzy, but it's not fuzzy math. It's true. 9.94%. And these, you can see the date range here. 2014 through 2023. Market was up 9.94. Anytime the market is positive in this, it's called a trigger, or you have a 9.9% cap. I prefer the trigger. Market's positive at all. Again, 0.1, it's green. You got 8.7. Market's down 20, in this case, 7.73, you got 0. I'm going to go to something that's even more exciting in terms of a spot to show you a few things. Here, I am going to go over here and forgive the commercials on the sides, but let's go back a lot longer. Let's go back in time, way back here. Imagine that in 2000, let's talk about what would have happened with each of these products. 2000 on the Pac Life, you broke even. your 100's still 100. In the market, it's 91,000. 90,900, but who's counting? In the Pac Life, you have 0. If this was equitable, okay, well, you're in a 5-year product. Technically, it's a 5-year point to point. So, but for all intents and purposes, you get the full upside of the market. You have the 20% downside protection. And if the market is positive, if the market is negative less than 20%, you're actually going to make that return. So you're not going, it depends on the product that you're in. And that's why a lot of our clients don't own just one of these. They actually own all 3 of them. And the Pac Life just came out with these great numbers. Let me just do. Okay. My computer may have froze. This is awesome. Okay. Over here. The Pac Life is super simple. Market's up, you make 8.7. It doesn't matter if it's up 20, you only get 8.7. If it's up 0.1, you get 8.7. If it's up 5, you get 8.7. If it's down 25, you get 0. So here's what I'd like to share with you about the equitable. And we've got a few minutes left before we get to the Q&A. But here's an example. 468 one-month rolling periods. Go back to the same 1980. Look at the first 5 years in this case. And then drop that's 1 5-year period. Drop January of 80, add January of 1985. That's 2 5-year periods. There's 468 5-year periods in here. 82.3% of the time, the S&P 500 was positive. You would have received that return because it's 100% par on the S&P 500. Okay, you don't get the dividend, but you didn't give up much, and you made money 82.3% of the time. 16.2% of the time, the market was down between 0 and -20. That's a lot. That's a lot. I mean, there's a 16% chance that you could lose. But in this contract, if the market's down between 0 and 20, you turn the frown upside down. You take the horizontal hash mark, you put a vertical hash mark through it, the negative becomes a positive. So now you just took the 16.2% of times that you would have lost investing in the S&P 500. VOO is the best index, by the way. Here, that would have been a positive. This loss is a plus. You made that amount. That's incredible. So that leaves us with this 1.5% of the time that the market was actually down more than 20. Well, in the real world, you lost whatever it went down, plus the fees that you paid your professional manager if you're doing that, which many, if not most of you are. Okay. In this product, you only lost the difference between 20 and whatever it really went down. Okay. So back where it was, now I lost my S&P one. Hold on a sec here. Back here. I mean, even in 2022, with 20% downside protection, you were okay. And if this was your return at the end of 5 years, you actually made 18.11%. That's amazing. So we're not going to be able to explain all of this today, but what I would encourage everyone to do is to contact us and ask us for the information. You know, this would have been a plus 4.38% in the equitable dual direction. This would have been a 0 inside of the Pacific Life. This would have been a 0. So really incredible products to mitigate the risk in your portfolio. You can beat the S&P with the Athene Amplify. incredible risk mitigation on the equitable. Markets down 20, you make 20 over a 5-year period. Nobody can change any of these participation rates. What I didn't tell you about the Pacific Life, that 8.7 trigger or that 9.9% S&P cap, 0% downside, 0% fees, they cannot change the rate. It's locked in for either 5, 7, or 10 years. And that's the duration of the surrender period on that contract. You choose 5, 7, or 10. I don't know why anybody would choose 5 or 7. If somebody's going to offer me 10 years of guarantees, I want 10, especially if the rate is higher. Imagine a mortgage. Would you like your rate guaranteed for 5, 7, or 10? And the 5 and 7 year rate guarantees were higher than the 10 year if you're talking about a mortgage. I mean, it's nonsensical, but it's locked in for the entire period. Pretty great. So Val, now that I've got everybody thoroughly confused, hopefully everybody contacts us and asks for additional information. And the team at Somerset is anxiously awaiting by the phones, just like they're raising money for NPR or Jerry's Kids or something. So we're ready to and on standby to assist. Are there any questions in the hopper over there?
Yes, we do. We have a question. Is income from this taxable?
Is income from this taxable? Well, there's 2 types of money primarily. You have non-qualified money, which is after-tax money, and you have qualified money, which is pre-tax money. And so that's money that you received a deduction on your tax return. You reduced your adjusted gross income by that amount to invest in those. So naturally, anything coming out of a qualified plan is totally taxable. Non-qualified money, you put in 100 and it grows to 200. The first 100 coming back to you is going to be treated as taxable because it's last in, first out. Prior to August 13th of 1982, it was FIFO, first in, first out. And so they figured that one out 42 years ago. Roth money is all Roth. It's treated the same. Tax-free is tax-free. Qualified money is all taxable. Qualified is qualified. It's all taxable. Non-qualified, you have tax deferral until you actually start to withdraw on it. So you're earning interest on your premiums, interest on your gains, and interest that would have gone to the IRS and your state government if you have state income taxes in the form of taxes. So you're earning more money and stacking more money on top and compounding more money on top inside of an annuity that is non-qualified than you would outside paying taxes. And that's why people love annuities. We're really good. Why would you deal with something today that you can put off until tomorrow? It's kind of the American way. That's what an annuity does for you. I'm ready for the next one.
Great. So how would Pacific Life make money if they pay 8% when the market was 1%?
Yeah, great question. In a word, options. These are all options. And this is what the pricing does these days. And when you say options to most people, it scares the you know what out of them, the poop. It's scary. It's unfamiliar. And it seems like the people that are selling the options make all the money. Well, here, this is contractually guaranteed. It's very easy to understand. In the old days, in order to understand a computer, you had to know how to write code and plug everything in. And Microsoft made that so much better. Oh my gosh. I mean, and revolutionized it so that lay people could type things into the computer and they didn't have to do all kinds of code. And then it got better and better with browsers. This is so easy to understand. Anybody can understand it, truly. So it's all options. That's what they're doing. And that's the price of these, the pricing on these options. Outside of annuities, those are called structured notes. And with those are available through Somerset as well. But this is the easiest way to understand them. Okay. And that's how they do it. And you know, it's one of those things, you know, the little old lady from Pasadena doesn't care how many BTUs are in that heater and all the other things. She just wants to know that it'll keep a little old lady warm. And in this case, you know, it's like, but how do I know that I can trust that company? Each one of these, the 5 with Equitable, the 6 with Athene, the 10 up to 10 with Pacific Life are all contractually guaranteed. They can't change the rate on you. It's not a teaser rate. It's all the way through, so you can trust it. And again, Pac Life has excellent commercials and they help humpback whales, so I like them. What's next?
All right. Is there a guarantor fund if these companies go under?
Every state and 3 territories, Guam, Virgin Islands, and Puerto Rico, have state guarantee funds as a backstop to the insurance industry. Insurance companies are the backbone of this country. In this business, there's only 2 true guarantees. And when I say 2 true guarantees, people immediately think about death and taxes. It's that too. But it's also the federal government and government agency obligations, Freddie Mac, Fannie Mae, Ginnie Mae, Sally, and the one that everybody knows, FDIC. And they're subject still to the underlying claims paying ability of the great United States of America and our incredible printing press. If you want to see how well it's doing, just go to usdebtclock.org, and it's fairly tragic, but we are still, as I always say, a C+ in a classroom full of Ds and Fs is an A+, and that's still us for now. Annuities are the other true guarantee. They're subject to the underlying claims paying ability of the insurance companies. However, you also have the guarantee funds because the insurance companies are very smart, regulators are smart, and they recognize that if insurance companies, well, if people can't trust insurance, if you default, they're not going to trust it. Why would you pay the premiums if it's a crapshoot that it'll pay off? And, you know, to date, nobody's ever lost any money within the guaranteed, within the general accounts of any insurance company in the US. It's not that they haven't defaulted. You know, when I got into this business in 1990, we lost a few. We had, you know, Mutual Benefit. We had Executive Life, which was a real big one. Fidelity Bankers, Capital Life. That money was tied up for up to 5 years, but everybody got their money back. And that was wonderful. And they received persistency bonuses and interest rates for staying the course. Not that they had a choice, but it worked out. When 2008 hit, we had hundreds and hundreds of bank failures, no insurance company failures. If I pause long enough, people love to say AIG. I remind them that the I stood for international, not insurance. I remind them that it wasn't the insurance unit's fault that happened. It was the LA and London units, and the government did backstop them. Too big to fail. Everybody remembers that. But we made money on that one. Imagine that, the government making money on something, 57 billion of profits, and that one worked out. You know, you can trust insurance companies, and well, you can trust them that your principal is safe. And with these products today, you don't have to trust them on the renewal rates because they're guaranteed for the entire time. And that's why I love annuities. And unlike Ken Fisher, who hates annuities, and other people like him, they're selling against them because they don't want to lose this money on Wall Street. That's why New York has horrible, deplorable, punitive annuities. Their immediate annuities are the same. Their MYGAs aren't as good, and they don't even offer FIAs with guaranteed lifetime income or good FIAs because Wall Street and their lobbyists are too strong. So anyway, another question, please, Val.
Yes. Do all 3 annuities have a 100K minimum?
No. Amplify, $10,000. Great product. You know, you can buy them, you can ladder them, you just keep buying them. It's wonderful. You know, personally, I have 8 of them. Just had one issue literally yesterday. And I absolutely love and believe in that product and all of these. 25,000 on Equitable. I think the minimum on Pac Life is 5 or 10,000. It's just that you get a slightly higher or lower rate. I don't know what it is on the 9.9 cap drops to something, but I still think it's close to 9. The trigger goes from 8.7 down to 8.25. Still incredibly compelling. And again, I think the buy-in on that's around $10,000. So I think I covered all three. What's next?
Buffered ETFs are getting more popular, liquid and not locked in. Please compare.
Well, by a buffered ETF, you know, that's what I referred to earlier, a structured note. And you'd have to compare them just as that's a very good question. You'd have to compare them with the actual annuity compared to the actual ETF and see which one's for you. So remember, with non-qualified money, you receive tax deferral with the annuity. You get all the compounding on the principal, the earnings, and the money that would have gone to taxes would have gone to the government in the form of taxes. Rockefeller was quoted as saying when responding, when they asked him how he kept so much of what he earned, he said, "I don't pay taxes unnecessarily on money that I'm not using the income to live off of." And that speaks volumes. So if you want to pay taxes as you go along, then go for it. If you want to defer it and turn it into a giant amount of money that you can then take income off of, and where your olive tree is young at 100 years and your onion plant is dead in 9 weeks, I'd like the olive tree. And I don't need to cut down the tree to get to the fruit because, you know, I have a ladder.
Great. I think we have time for one more. The question is the 8.7% guaranteed if the S&P goes up or not? Can you explain how that trigger works?
Yeah, absolutely. If the S&P is positive at all, anywhere from just anything great, 0.01, the market's either up or down. The market's never ended at 0, because if you go out far enough to the right of the decimal point, you're going to find a number, I promise you. And so if it's green, you make the 8.7. If the S&P is up 0.01, you get 8.7. If it's up 2, you get 8.7. If it's up 5, you get 8.7. If it's up 100%, sorry, hopefully you own Equitable and Amplify, you got 8.7. So market's down, by the way. Conversely, market's down 5, 10, 15, 20, 50. Did that almost once, I think in 1931, 40 something, 43, 44. You broke even. You didn't pay a penny in fees either. Your 100's still 100. How wonderful is that? When do you get to go to Vegas and bet on craps, which are the best odds in Vegas? And I'm not a gambler, I just happen to know that. 50-50. You put it on pass, on the pass line, and it lands on don't pass. And that guy with the little rake, he leaves your bet alone. How great is that? That's the Pac Life. Somebody please write that down, Team Somerset, or reuse that. Thank you. Okay.
Awesome.
If there's a couple more, we can go a little over. If people want to stay, they can hang up. It's going to be on a recording. Let's answer people's questions.
Okay.
Find a hard one.
Let's
read anything.
Okay. How much upside do you give up with a 20% buffer versus a 10% buffer?
Wow, great question. Let's go to the internet and take a look. You know, again, anybody who wants this, we're going to share it with them. Our goal is to educate, not to sell anybody anything. And most of the people would say we're not very good salespeople anyway, but we're good teachers. So if we go in here and here's a 20, okay, buffer. Here's the 6-year. The 10-year, the 10% was 136. This is 125. You're not giving up a lot. So here you go. 78 versus 98, net of 87 versus 95. Okay, 87 is more than 78. You beat the S&P by 900 basis points. You gave up 1.31, so that's kind of a wash. If you had 1.31 and you look at that over 6 years, that's about 9%. Okay, here you beat the S&P by 9%. So on the upside, inclusive of the dividend, and this is net of the 0.95, you still tied the S&P 500 with 20% downside protection. However, let's look at worst. And here's why this one's still -6. And I'm going to switch to a different product with no fees here in a moment, because the S&P only went down 10 at the worst period, going back to January 1st of 1980 and looking at the first 6 years and then rolling through it every single day where Athene does her numbers. 14,000 times it was only down -10. So that's a really good risk reward, because if we looked at best, -10 versus 207, I mean, those are really good odds, right? 20x up to every one down. That's incredible. So here's what I would do if you're looking at I'm going to go to, let's get back to here. Let's go to NF for no fee. Put in your 100,000. Go over here and choose S&P. And then let's choose 10% downside protection. 6-year term, 100% allocation. Okay, now look at this. You don't have 195, you have 191. So you're 4% less because your par is only 116 versus 136, but you don't have a fee. So when you see this is up 91, it's reflected here because there's no fee. Here, you still beat the S&P 500. Pretty great. But now let's look at, well, let's look at best. You still beat the S&P by a lot, right? And now let's go to worst, my favorite. Not that I want that to happen, but this is what you want if things don't go so well. You lost 10% over here with the S&P. You were down 0.4 because you had 10% net because of no fee downside protection. Pretty incredible. And so that's, I mean, wow. Let's look at this one real quick. NASDAQ only has a 10% downside buffer. Historically, that's all you need, but this is the no fee version of it. And that's the greatest thing about these products. We can mix and match them depending upon the index that you're going in, because it's not one size fits all. Most recent, you only have 100% of the NASDAQ. NASDAQ has like next to no dividends anyway. And there's a cap on it of 105. So why would I recommend this? The answer is I wouldn't. I would go back here, and now you want the NASDAQ, and we want to see if there's a spot that makes sense for you. We go over here, we go to NASDAQ, 10%. This one has the fee, but what you're going to see is that it has 110% par. And on a net basis, you equaled the NASDAQ. So why would you buy this versus buying the actual QQQ? Why? Here's why. Worst. I guess it didn't matter. The NASDAQ didn't lose over a 6-year period. So there is a strategy in here that makes sense for the NASDAQ, and I'll share it with you. But as you can see, the worst 6-year period for the NASDAQ was a plus going back over the same time period, and that's incredible. Val, what's next?
What happens to my initial investment?
What happens to it? Your initial investment goes directly to 1, 2, or all 3 of these insurance companies. If you invest with them and us, nothing's made out to Somerset. It goes directly to them, and it gets invested with Athene. It's on the 8th of the 22nd. With Equitable, it's on the 1st and 3rd Thursdays when they do the buy-ins. With the Pacific Life, it's the day that the money hits, and you get allocated into the different allocations that you select. And I'm going high level here today, S&P 500, but There's a lot more diversification within the products that you can divide your money among. There's a contract or a policy issued, and Val's laughing because what are you thinking? We're going too far, too much time. What am I missing? Are you gonna have to share that with me after? So anyway, you get a policy. You can put it in your safe, your fire safe, your safety deposit box, or you can lose it and we'll send you a duplicate. So what's next?
What is AM best rating on these three companies?
A+, Superior, Pac Life, A, Athene, A, I mean, that's A, Excellent, and A, Equitable. Athene, fastest growing insurance company in the United States, founded in 2009, born of the ashes of fear after the global meltdown. Some of the brightest minds in finance, in insurance and annuities came together, and they got some of the brightest minds in finance with Apollo to create this company. And it's a beast. I mean, my projection, largest company in the United States within 10 years, maybe the world. In insurance, largest company will be Tesla, but that's another conversation. And I'm not doing so well on that one lately, which is exactly why you should invest in these products. What's next?
You said one product gave you access to either 10% of your money or 10,000 a year. Are there fees on that?
10% of your money or 10,000 a year. It depends on the product, but let's just take the simple one, Pac Life. You know, in the first year, you can pull out $10,000 if you needed it. First year, you have access to 10% of your premium. I wouldn't recommend it, but if the market's down, you know you're going to break even, you could take it from there. That's arbitrage, team. So market's down 20, you're not going to make any money. You're going to get a zero. So might as well pull your 10% and put it someplace else. Buy QQQ, buy VOO, S&P with your $10,000. That's arbitrage. That's fun. It's a fixed guaranteed return annuity. Market's up 8.7 at the end of a year. You get to pull out whatever 10% of that number is. That sounds like $10,087. Yeah, so no, 10,870. Excuse me. Yeah. So no cost. It's great.
Awesome. Well, if anyone wants to continue the conversation, how do they get in contact with you? Is there an email? Is there a phone number they should call?
Yeah, great. 800-813-4000, 800-813-4000. I've had that phone number for 27 years or so. Let's pull it up on the screen here. For those of you that are visual, 800-813-4000. You know, you can email to this email address. Many of you have our direct emails. Contact your Somerset advisor. You know, if you're not one of our clients, gosh, we'd love to help you. I mean, you know, since when does it make sense to pay people a lot of money to manage your money and you underperform the S&P 500 on the up and the downside? You know, it's just, you know, even if you stick with your managers, it's wise to diversify. How does that not make sense to, you know, throw some Equitable and some Pac Life and even some Amplify in there to complement what he or she wealth manager is doing for you and charging you 1% plus per year? How does that not make sense? It's just smart. It's just wise. And we have a whole lot of ways at Somerset to help you save for retirement. I mean, gosh, a guaranteed lifetime income has never been at a higher level than it is now. And I was involved in helping design the first product back in 92, 93 for fixed indexed annuities. You can lock in this guaranteed lifetime income, as the name would imply, for the rest of your lives. I mean, if you have a married couple, ages 60 to 65, you know, you can turn on income immediately and it'll pay out as long as you live. There's just so many great opportunities out there right now. And, you know, these are just three of our favorites that are bellwether flagships inside of our portfolios because, you know, they just do incredible things. And thank you everybody for joining today. Clearly went over, but I didn't go over on the first part of the presentations, just the questions. And we'd love to hear from you. We'd love to have all your questions. We'd love to have, we'd love to be able to send you information. We'd love to be able to send you the links and everything that we use, because it's our goal to teach you to fish, not to give you a fish. It's our goal to educate, not to sell you anything. And I hope everybody has a wonderful weekend. Thank you so much. We appreciate you.